Hello, I'm Julie Price, and welcome to Juniper's fourth quarter 2020 economic review. I'm recording this video on election day, so I don't know the results yet. It may take days, weeks, or even longer, but hopefully we'll have the results soon. The overriding theme that you'll hear from me is to not let politics affect your investment decisions. Now, having said that, JP Morgan predicts a 40% chance that we'll have a Democratic sweep, a 40% chance for a Republican sweep, and a 20% chance for a divided government. Now, a Democratic sweep would be the biggest change from today's environment, and honestly, the market isn't very fond of uncertainty. Since we saw the first fiscal relief package earlier in the year totaling $2.4 trillion, I've been talking about the need for politicians to really work toward getting that debt paid down quickly before inflation kicks in. If the next fiscal package is about the same size as the last one, we could see a total of $5 trillion of debt added this year. What concerns me is that Trump doesn't really intend to raise taxes, and Biden's increases are actually a little bit modest. For example, the corporate tax rate under Obama was 35%. Under Trump, 21%. Biden is proposing a 28% corporate tax rate. For personal taxes, Biden's proposing an increase for those earning over $400,000. I just don't really think that this is going to get us where we need to be. But raising taxes doesn't buy you votes, and neither does fixing Social Security. So we'll just kick those cans down the road another 4 years. The virus is really at the front and center of this recovery. So where are we at with the vaccine? We could be even as few as 3 months away from all seniors being vaccinated. That would be a tremendous breakthrough and an incredible relief to us all. But we may be facing another wave, potentially larger than the first couple of waves. And that's a real threat too. So let's get started with this quarter's review. I'm really excited about some new slides that I'll be showing you. And as you listen, feel free to stop and pause the slides and read some of the information on there. There's lots of good information there. So here we go. Here is the matrix through September 30th. Fixed income is the highest performing asset class so far in 2020, up 6.8%. Even with the Fed funds rate at 0, fixed income is an asset class worth holding. Large cap U.S. equities is next at 5.6% and cash at 0.5%. From there, the year-to-date performance is negative, with the 60% equity, 40% fixed income of the asset allocation blend pretty much flat so far. High-yield bonds are down a bit at about 0.5%. Emerging markets is down about 1%, held up largely by China. Developed markets are down 6.7%. Then we have small cap equities and real estate rounding out the laggards. Still a tough year for many markets. Here's a chart I haven't shown before. It measures the inflows and outflows of mutual funds and exchange traded funds, or ETFs. Year-to-date, September 30th has seen $165 billion in outflows from U.S. equity funds, higher than any other year going all the way back to 2003. World equity outflows have also been enormous, with year-to-date outflows of $51 billion, also the highest since 2003. Where did the money go? Some to fixed income, but mostly to cash. This helps to put in perspective just how much a sell-off affects prices. Here's a chart I try to include each quarter to monitor the price-earnings ratio of the S&P 500. We do this because it helps us to see how the market is valued. The 25-year average PE is 16.46 times earnings, which means that you have to wait 16.46 years to collect enough of the earnings to make up for the price of the stock. PE decreased sharply with the onset of the pandemic and all those outflows, and increased as the market entered the recovery. With the recent decline of the S&P at the end of the third quarter, PE fell to 21.54 times earnings, now 20.60 at the end of October. So even though it's been a little painful to see stocks decline recently, it's making for a more reasonable PE ratio. Looking at earnings, the S&P 500 has been experiencing increases in earnings per share in 2017, 2018, and 2019. 2020 is estimated to have lower earnings, understandably, but look at the analyst estimates for 2021 and 2022. This is the prize we need to focus on. Let's talk about growth versus value, two fundamental approaches in investing. What is growth and what is value? Growth investors are looking for companies that have strong earnings, hoping for a higher stock price in the future. Value investors seek undervalued companies with low PEs. Investors have been looking more toward growth for the last 5 years as a defensive move, as we see growth starting to get more and more expensive as value gets cheaper and cheaper. With the onset of the pandemic, growth got temporarily cheaper, only to again continue to get more and more expensive. Here's a new chart from JP Morgan's deck of slides that is really interesting. In the first data set, we see a breakdown of industries of the GDP, gross domestic product. GDP is essentially the total of goods and services produced by the United States. Technology, a growth sector, makes up 6% of GDP. Now let's look at the next data set, employment as of August 2020. Here we see that technology makes up 2% of the workforce. Now let's move on to the third data set, composition of the S&P 500. Tech stocks make up 39% of the S&P. So let's compare that to a value sector like industrials and materials, which makes up 18% of GDP, 17% of employment, and only 11% of the S&P. This is a great chart to illustrate some of the disconnect between the gradual improvement of the economy and the labor markets versus the rapid rebound of the stock market. Another new chart that is also very interesting is this one that looks at U.S. small cap stocks in green versus large cap stocks in gray. Information technology is twice as heavy in large cap companies, while small cap stocks are tilted more toward cyclical sectors like financials, healthcare, and industrials. What's really interesting is that on the right side, it compares market drawdowns to the next 12-month rebound. During the tech bubble back in 2001, large cap stocks fell 49%, but only recovered 35% in the next 12 months. On the other hand, small caps fell 43%, but recovered 61.5%. We saw the same thing during the global financial crisis of 2008, where small caps fell just a bit more than large caps, but look at this, a 98% increase in the next 12 months. We've seen small cap bounce pretty well the last two recessions. Will we see the same phenomena 12 months after the COVID recession? We shall see. Here we see year-to-date performance of the sectors and industries that illustrate how uneven recovery has been. Way out in front is online retail, then home improvement and information technology, the winners of the pandemic economy. At the other extreme is energy due to oil, air travel, entertainment, and department stores, the pandemic sufferers. We'll look more at sector data in the next slide, but take a moment to look over these numbers. Here we see high-frequency data for the various economic activities. 0% is the baseline, where most areas were at prior to COVID. We shut down the economy and seat at dinners, in purple here, go pretty much to negative 100%. Glad you don't own a restaurant? What a blow. You see that this has been gradually improving as restrictions ease. Air travel didn't quite go down negative 100%, but pretty close. And they haven't been recovering as fast as seated dinners. Hotel occupancies have been coming along, but still at about 35% under baseline. Then we have new mortgage apps and debit and credit card transactions at near or above baseline, two areas of economic activity that aren't dependent on an in-person transaction. So you can see how some of these areas have had such a difficult time recovering. Touching on unemployment, here's where we're at on September 30th. 7.9% unemployment, a great improvement from nearly 15% earlier this year. With the Fed funds rate range at 0 to 0.25%, the yield curve has returned to more of a normal sloping yield curve, but still at much lower points when compared to 2013. This chart looks at the Fed's balance sheet over 4 rounds of quantitative easing, as well as the forecast through 2021. In quantitative easing, or QE, the Fed buys assets to increase the flow of money and credit into the economy. They used to buy pretty much just treasuries, but started expanding the assets they bought with the 2008 Great Recession to include loans, mortgage-backed securities, and other assets. In this round of QE that started in March, they've almost doubled their balance sheet expansion since the last round that occurred between 2012 and 2014. Just a reminder of the massive amount of investment the Fed has been infusing into the economy and will likely continue for at least the next year. So what is the Fed trying to accomplish? Well, they have a goal of 2% inflation, and we were only at 1% in July. Averaging the last 3 years, we have inflation of 1.67%. We would need inflation of 2.33% in order to boost the 3-year average to the 2% threshold. Dr. David Kelly, Chief Global Strategist at JP Morgan, says he doesn't think the 2% is important, but the fact is the Fed thinks it's important. Since Japan and Europe can achieve it, he's not sure why the Fed is set on the 2%, but that's what they want to see before they raise rates. So we could be at zero interest for some time, and that is not helpful for bond investors. Looking at fixed income, we see that bond yields are starting to stabilize when we compare this quarter with last quarter. Year-to-date performance has been strong. Look at the performance of treasuries, corporates, and aggregate. The main bond funds that I use in portfolios are comprised of the types of bonds found in the U.S. Ag, a broad-based index comprised of intermediate-term investment-grade bonds, including treasuries like these, corporates, and securitized bonds like mortgage-backed and asset-backed securities. On the right, we see bonds issued in the first 8 months of 2019 in gray compared to the first 8 months of 2020 in blue. This chart illustrates how falling interest rates and Fed action really helped to boost bond issuance in 2020. Even though the yields are not what they once were, they are still a very useful diversifier in portfolios. Globally, the country with the highest year-to-date return is China, up 16.6% in US dollars. Germany has broken into positive territory, up 0.7%. But Europe, the UK, France, Brazil, and Russia are still having a tough time. The US has had the largest slice of the tech pie, representing 28% of global market cap, while emerging markets capture cyclical cycles like manufacturing. This chart looks at the stark differences in the fiscal responses of various countries. The US had the largest spending and revenue measures, followed close behind by Japan. Germany had the largest response when loans, equity, and guarantees are added in, which may have helped them break into positive year-to-date performance territory. It's tougher for emerging markets countries to be able to provide the same level of stimulus like developed nations can. But for a country like China that emerged more quickly from the virus, they really didn't need as much. But countries like Mexico, Russia, and India could have used the support. Let's look at the spread of COVID in regions throughout the world. The US and especially Europe are seeing massive increases in cases. This data is shown through October 29th. Very concerning at home here in the United States. A vaccine couldn't come soon enough. On the other hand, Asia and Latin America seem to be faring better. Deaths have plummeted in most areas of the world, but are dangerously increasing in Europe. I'm looking forward to the day when we're on the other side of this. This is the heat map for the Global Purchasing Managers Index for services, showing annual PMI by country, where most of the world came to a screeching halt in the first and second quarters of 2020, shown in red. Now, with the third quarter numbers on the chart, we see many of the countries are green, with the exception of Japan and India in red, and Spain, Brazil, and Mexico in orange. Still, it's promising to see better PMI numbers, a leading economic indicator for services. This slide looks at consumer confidence by political affiliation. The blue line shows how Democrats feel about economic conditions, the Republicans in red. The gray line shows the results of everyone that was polled. During the previous expansion, there was a large surge in consumer confidence for Republicans and a decrease in confidence for Democrats. The bottom line is that it's critical that investors not let politics dictate how they invest. Here's another new chart. I love this one. This page shows the S&P 500 returns and real GDP growth during periods of Republican, Democrat, and divided government control. Democratic control, for example, is defined as a Democratic president with a Democratic majority Senate and House of Representatives. Over time, markets have enjoyed solid returns, and the economy has continued to grow under all configurations of government. Just take a moment to review this slide. There are good years, bad years, and flat years in all three combinations of government. Another reminder to not let politics drive your investment decisions. Well, congratulations for making it all the way through the fourth quarter economic review. And thanks to Dr. Kelly and his team at JP Morgan for putting together such great resources. We can get into some really deep dives on the topic of finance and investments, but I hope that the information provided in this video was easy for you to understand, that you can walk away with a few nuggets. I'm taking meetings by phone, Zoom video calls, and safely conducted in-person meetings. So if you like what you hear or have any questions, feel free to give me a call or shoot me an email. Thanks and have a great day.